Hi everyone, my name is Simon Mishevich from Optimized Accountants. In this video, we're going to be talking about Form 2555 or the Foreign Earned Income Exclusion, which is really important for Americans living abroad or green card holders also living abroad. And if you're looking for tax calculators in the US or the UK for that matter, then feel free to go over to our website using that QR code that's shown on your screen now, or there is a link in the description box as well. Okay, so now we need to talk about Form 2555, the Foreign Earned Income Exclusion, which is really important for you to understand. So the form is used to claim Foreign Earned Income Exclusion, the FEIE, which allows US citizens or resident aliens to exclude certain amounts of foreign earned income from US taxation. And this is basically saying I had employment income from, and this works also for self-employment by the way, you can have it for employment income in a foreign country and just say, hey, the IRS, I'm excluding this amount of income from my tax return. Really beneficial for many, many people, especially those that are in low tax countries. And we'll talk about why I might say that later on. Okay, so let's go through an example of foreign earned income exclusion using Form 2555 on your 1040 IRS tax return. I'd say all that, it's a bit of a mouthful, so maybe just reverse that and just listen to it again, because there's so many forms that you need to file with the Internal Revenue Service. Okay, so employment income, let's go for this. So you have $90,000 employment income, bearing in mind if you are doing your taxes, you'd have to add up your wage slips from January, February, all the way through to December. You couldn't use your year-end summary from the UK, for example, because that runs from the 6th of April to the 5th of April. It doesn't work. You'd have to take your individual wage slips and add them up. Then you have to convert it using the IRS conversion rate, which in this example gives you $90,000. Very complex, right? So here you've got the foreign earned income exclusion of $90,000. What's your taxable income? Zero, of course. And that is the benefit of using foreign earned income exclusion, because you're saying to the IRS, you can't tax me because I don't even have the income in your eyes. The maximum of foreign earned income exclusion for 2023, when you do your tax return in 2024, is $120,000. If you earn more than that, you may benefit from other things like foreign earned, your home exclusion, your foreign home exclusion. But above and beyond that, you will then have to declare that income to the Internal Revenue Service. So if you're earning $300,000, no doubt you will have to declare some income, but you would take off this $120,000 of foreign earned income exclusion, and then whatever you're left with, that would be taxable by the IRS. There are drawbacks. Okay, so, and I've done this so many times with our clients, they say, well, actually, there are, in terms of the UK, for instance, it's not really a good use of foreign earned income exclusion, and there is a good reason for that. Loss of certain tax credits. Now, if you've seen some of my other videos, I talk about the foreign tax credit on Form 1116. And in high tax countries, that's sometimes better for you, because what you're saying is, well, I have my income, let's say again, 90,000. I've been taxed, let's say $30,000 equivalent, and therefore I'm going to deduct that $30,000 from my US tax. Most times you'll be paying more tax in the United Kingdom than you will be in the US, unless you're living in New York or California. So with that in mind, you bet sometimes are better to use foreign tax credits than the foreign earned income exclusion form. So make sure you get some good tax advice to understand your situation, especially in which state you're in as well. High tax rates of income over 32%, for instance, versus 10%. Now, the start tax band is 10% in the US, but if you use this foreign income exclusion, then 120,000 is removed, and your tax bracket that you have will start at the higher tax bracket, not the lower tax bracket, for the excess of your $120,000 I described earlier. So, and that can catch people out because they think, well, actually I should start at 10%, shouldn't I? No, you start at the higher tax bracket for the calculation of taxation. Third thing is impact on standard deduction. Using this, you could lose your standard deduction altogether. So that could also be a drawback, especially if you've got high medical bills or education fees that you could have deducted. You may not be able to do that now. Social security benefits impact. If you're saying to the IRS, hey, I don't have any employment income at all to tax, well, guess what? Your social security benefits when you retire, you may lose those. You need 40 taxable credits for you to benefit from a full US state social security benefit. If you don't have that because you're saying to the US, well, hey, I don't have any employment income because I'm using this foreign earned income exclusion, you may be penalizing yourself later on from your retirement benefits. And the retirement benefits in the US are far more generous than they are in the UK. UK, you're probably looking at £10,000 by the time you retire. In the US, it's 30,000, getting on to, or probably be $40,000 by the time you retire. So you're losing a lot of benefits. So it may not be the best thing for you. State taxes exclusion. I'm going to just talk to you about that. But foreign earned income exclusion is great for your federal tax return. But if you have a state tax return to file, you may not even be able to use the foreign income exclusion and therefore wasting your time. Okay, so let's now talk about the states that do not allow foreign earned income exclusions. And that is California, New Jersey, Pennsylvania, Virginia. And guess what? They are high tax states. So if they do not allow the foreign earned income exclusion, they're going to say to you, well, I don't care what you've done on your federal 1040 tax return. In the state tax, we're going to ignore it. We're going to give you something else instead. So it's really important for you not just to willy-nilly just say, I'll use this form and benefit from that, because you may not. You need to get some good tax advice whenever you're doing this thing.